In this video, we're going to talk about 3 of some of the best monthly dividend ETFs that provide both high and consistent yields, and you can combine these 3 funds to make a solid 3 ETF income combo for your investing portfolio. So let's not waste any time and get right to it. First up, we have QQQI, the NEOS NASDAQ 100 High Income ETF. The objective of QQQI is to generate high monthly income in a tax-efficient manner with the potential for equity appreciation. The targeted benefits of QQQI strategy include providing high monthly income from investing in the NASDAQ 100 and implementing a call option strategy. Second, it takes advantage of tax loss harvesting opportunities along with utilizing NASDAQ index options that are favorably taxed. Then last, it uses a call option strategy that may include both sold and purchased NASDAQ 100 options, which could provide the potential for capital appreciation. Getting into the portfolio makeup of QQQI, this ETF has a total of 107 holdings, with top holdings in NVIDIA, Apple, Microsoft, Broadcom, and more. And these top holdings make up around 53% of the portfolio, so it's pretty top heavy. And for the sectors that it's primarily exposed to, we have technology up top, communication, and consumer discretionary. So nearly the same holdings and exposure that you'd find with the NASDAQ 100, leaning heavily on technology. Moving over to the income, QQQI has a dividend yield in the double digits of 13.3%, and the dividends are paid out every single month, thanks to the levels of volatility that the NASDAQ 100 has provided. Higher volatility leads to higher option premiums, and the bigger the premiums are, then the more income potential that QQQI can provide. Now, if we take a look at the dividend payments over the last 12 months, you can see that it's been very consistent with the payouts, mostly ranging between 61 cents to 64 cents a share, with the largest drop stemming from the tariff-related market dip back around in April. For the fees, QQQI comes with an expense ratio of 0.68%, costing $68 for every $10,000 invested. Now, this may seem a little bit high, but remember, this is an actively managed fund, and these fees are included in the total returns. Which leads me to the performance of QQQI, because this fund has only been around since January 2024. It doesn't have a long history, but since its creation, it's had total returns, including dividends, of over 43%. Some great performance from this fund in a short time. The NASDAQ 100 has had some excellent returns over the years, and this fund is using that solid performance to provide you with some really nice income. Next up, we have SPYI, the NEOS S&P 500 High Income ETF. This fund seeks to generate consistent high monthly income in a tax-efficient manner with the potential for capital appreciation. The targeted benefits of SPYI strategy include generating high monthly income from investing in the S&P 500 and using a call option strategy. Also, the same tax loss harvesting opportunities that you have with QQQI. And last, it uses a call option strategy that may include both sold and purchased S&P 500 index options. For the portfolio of SPYI, this ETF contains 511 holdings in total, with its top holdings in companies like NVIDIA, Microsoft, Meta, Google, and Berkshire Hathaway, so very closely matching the S&P 500 allocations. For the sectors, there's technology making up about a third, then financials, communication, consumer discretionary, and the remaining percentage spread in a few other sectors. For the income, SPYI doesn't disappoint with a dividend yield of 11.6%, and the dividends are paid out monthly. And if we jump over to the last 12 months of dividend payments, SPYI has been super consistent in its payment amounts, with the income primarily ranging between 51 cents to 53 cents a share, which is really nice to see, and that dip in April was less intense than QQQI's. Getting to the cost, SPYI has an expense ratio of 0.68%, costing you $68 for every $10K invested. As we know, the S&P 500 has been doing very well, and that same performance is reflected in SPYI. Since SPYI was created a little over 3 years ago, it's had annual returns of nearly 19%, including dividends. So it's been holding strong in the few years that it's been around. The S&P 500 has been dependable and consistent in the returns that it's provided over many years. And with SPYI, you're able to take advantage of the S&P 500's performance to generate some solid monthly income with a little bit of appreciation. This next fund to add to the combination of SPYI and QQQI is BTCI, the NEOS Bitcoin High Income ETF. BTCI seeks to generate high monthly income with the potential for appreciation based on its exposure to Bitcoin through spot Bitcoin exchange traded products or ETPs. There's three parts to BTCI's investment objective. First is that the fund invests in exchange-traded spot Bitcoin ETPs. And spot Bitcoin ETPs are funds that track the price of Bitcoin by actually directly holding Bitcoin as their underlying asset, and the ETP price will move with the price of Bitcoin in crypto markets. Second is that BTCI gains synthetic Bitcoin exposure through ETFs that invest in Bitcoin future ETFs. And this is done by using an option strategy of buying call options and selling put options at the same strike price on one or more Bitcoin futures ETFs. The purpose of this synthetic exposure is to behave like owning Bitcoin. And last, it uses a call option strategy to provide high monthly income that mainly involves selling call options on a Bitcoin futures ETF. As for the portfolio of BTCI, when you take a look at the holdings, you'll see a few different things. First, like I had talked about before, BTCI invests in ETPs, and currently the fund is holding HODL, the VanEck fund, along with IBIT, the iShares fund. Next, you'll see this name CBTX, which are the synthetic positions with CBOE Bitcoin US ETF index options. And then you have roughly 75% in treasury bills for collateral and some interest. For the dividends for BTCI, it has a dividend yield of almost 30%, which is pretty amazing. And if we look at the income it's generated in the year that it's been around, it can vary from month to month, since the volatility of Bitcoin will be the main driver of this. For the cost, BTCI has an expense ratio of 0.98%, which is pretty high, but the income that this fund has provided can make it well worth it. I'm sure many of you are aware that Bitcoin has experienced some really crazy returns over these last few years, which BTCI has benefited from. Since this fund was created in October 2024, it has had about 61% returns, including dividends, providing some returns that are much higher than many other covered call ETFs. The high payouts and yield that this fund provides, along with the higher potential for capital appreciation, makes this a strong option for an income investor that wants some Bitcoin exposure. Next up is combining these three funds together for a 3 ETF income portfolio. The combination of these 3 ETFs could serve as one slice of your total portfolio that's focused on income generating funds, or a solid 3 ETF income portfolio. This portfolio setup will give you an example of how the allocations could be, where I put 55% for SPYI, 25% for QQQI, and the remaining 20% for BTCI. SPYI being the largest here since it's based on the S&P 500, and its diversification helps with its role to be the foundation of this portfolio. It's still a cover call ETF, so don't expect it to perform as well as a true S&P 500 fund, but either way, it still provides some nice monthly income and some opportunity for capital appreciation. With QQQI being based on the NASDAQ 100, it makes it a much more aggressive fund with more volatility, so it can amplify the income even more than SPYI. That also allows it to have more potential appreciation, even though income is the main focus. Keep in mind that SPYI and QQQI have over 50% of overlap in weight between each other, with a majority of it coming from their top holdings, so those growth stocks are the big contributors. BTCI, on the other hand, is the third piece here for that high income that is able to provide, along with even more potential for price appreciation. While Bitcoin is the riskiest of the 3 holdings from these funds, it also offers much more room for potential income thanks to the volatility and upward trajectory that it's experienced. While Bitcoin is the riskiest of the 3 holdings from these funds, it also offers much more room for potential income thanks to the volatility and high growth that it's experienced. Since there's no Bitcoin exposure in SPYI or QQQI, this adds to diversifying the portfolio even further by extending beyond just stocks. And while it does invite even more risk to the portfolio, for someone that's bullish on Bitcoin, this could be an option that provides even more income, although the payments won't be as similar and as consistent. These three funds can be a powerhouse for generating income while also still giving you exposure to the underlying holdings and some room for possible price appreciation. Now, I want to talk about the pros and cons of a portfolio with these three ETFs. Kicking it off with the benefits, first is that since these funds were created, they've been providing some very consistent, stable, and reliable returns, with BTCI being a little bit of an exception. But while BTCI has had more fluctuations than the others, the payout amounts have been solid. Next would be that these funds strongly track their underlying assets or indexes. There's a variety of other funds that may loosely track the S&P 500 or NASDAQ 100, as they may only own a portion of the holdings. So it's nice to note that these funds have more exposure by actually holding a larger chunk of the indexes. Although it's not exactly the same case for BTCI since it uses synthetic exposure. Third would be that double leg strategy that NEOS uses for capital appreciation. So in SPYI's first leg, it writes calls on the underlying asset to generate income, but its second leg is that it uses a portion of that income to purchase out of the money call options. This lets SPYI capture some of the upside in a rising market. Last is that these funds have not experienced NAV erosion since their creation. While price appreciation isn't the main goal of these funds, they still have managed to capture some upside in price, which stems from their strategy. For the downsides, the first and most important one is the capped potential returns. This is a problem every covered call fund will face, and it's important to keep in mind. As these funds are providing income and not capital appreciation, they almost always underperform their underlying asset. Let's use SPYI as an example since it's the oldest of the three funds. If we compare the returns of an S&P 500 fund like VU to SPYI's returns, including dividends, over the last 3 years, you can see that the S&P 500 has performed much better in this time period. So by holding SPYI, you're forfeiting those returns that you'd be getting from an ETF like VU, which brings me back to saying that these funds should not be used as tools for growth. The next con is you're vulnerable to the same downside risk as the underlying asset. The income provided from the option premiums can help to cushion some of the downside, but if the underlying index or asset is getting hammered hard, so will the ETF. This leads me to the additional risk of having these covered call funds. And that risk is the fact that they haven't been around all that long, so we haven't seen how they'll hold up and perform through a variety of market conditions, especially since we've been in a strong bull market for some years now and haven't yet experienced a bear market or an extended drawdown. The last downside I want to put here is that the diversification of these three funds is a bit limited. Excluding the Bitcoin exposure, SPYI and QQQI are mostly exposed to large cap stocks, and they have quite a bit of overlap. You could further diversify this income portfolio by maybe swapping or adding other funds that give exposure to small caps, real estate, or even international. These cover call ETFs can be a powerful tool for providing income, but just remember that their strategy is geared for income. If you're in the accumulation phase of your investing journey and you have quite a while for retirement, you can miss out on a lot of potential gains by not directly holding the underlying assets instead. For those on the tail end of investing, some exposure to these higher yielding ETFs could boost that income that you're looking for if they make sense for your investing strategy. And if you want to see some more options on some great monthly paying dividend ETFs that aren't QQQI or jepq, watch this video here. Or if you want to see what's the best NASDAQ 100 monthly dividend ETF, check out this video here. If you made it this far, thank you for watching, and don't forget to like and subscribe. Keep on investing, and I'll see you in the next one.